Hersheys stock dropped over 30% in 2023 despite the broader market doing pretty well. In this video, I will be valuing Hersheys stock using my stock valuation spreadsheet to determine whether Hersheys is now at a good price to buy. I will be valuing it using the discounted cash flow model, the multiples model and the dividend discount model to come to an acceptable buy price that I would be willing to pay for this company. If you want to use this spreadsheet for yourself, then click the link in the description. Before I get into the stock valuation, I will just take a quick overview of the company, looking at all the key metrics that you can see on your screen. So in the drop down, I've actually included other similar companies. So we've got Hersheys, which is obviously a chocolate company, and we've got Mondelez, which is another chocolate company, and I've also got other companies in the snack industry. So this is a very useful tool to quickly compare and contrast. So I can just click Mondelez and all of these metrics will automatically update. So I am back onto Hersheys now, and the first thing I'm going to look at is the key metrics. So firstly, we've got the price to earnings ratio. So currently it's just slightly above 20. So my ideal PE ratio is to have it below 20, but it isn't too high in comparison. And if I just compare it with Mondelez, I believe their PE ratio is slightly higher. So in comparison to Mondelez, it is a better PE ratio. In terms of its revenue, over the past 5 years, it's gone over 7%. So it's shown that it's continued to grow. Its profit margin is also fairly healthy. It's not above 20%, which is what I like to see, but 17%, it's still an acceptable profit margin. And then the current ratio is above 1, which is always good to see. In terms of the debt to equity and long-term debt to equity, they are both above 1. So ideally this should be below 1. And if I just compare this to Mondelez, just because it's another company in the chocolate industry, their debt to equity is a lot lower, so that's something to think about. So back to Hersheys, we can see the price to free cash flow is just over 20. So in terms of a cash flow perspective, it does look like it could be fairly valued, but obviously we will do the valuation. In terms of the analyst ratings, we can see it's currently overweight, and the analyst price target is $210, which is slightly higher than the current price. So this is the current price at the moment, and this is the live price. So there is a bit of a difference there, but I wouldn't always go by the analyst ratings because they do sometimes get it wrong. So that's the purpose of this spreadsheet, to come to our own valuations and then we can compare it with this price target. So in terms of the technicals of Hersheys, we can see it's down over 31% from its 52-week high. And it is showing some recovery because it's up over 6% from its 52-week low. And in terms of the beta, it is currently well below 1. So 1 would represent the market, and anything below 1 means it's not as volatile as the market. So we can see Hersheys is well below 1 at 0.35. So to me, this is good if you're looking for that stable organization that doesn't fluctuate too much and isn't as volatile. And in terms of its dividend, we've got a dividend of 4.43 and a dividend yield of 2.33%, which makes this a mild dividend paying stock. And in terms of its payout, it's just under 50%, so it's 48.65%. which to me seems like it has more potential to grow. In terms of its earnings, we can see the revenue quarter on quarter has increased over 11%, and its earnings per share quarter on quarter has also increased a whopping 30%. So we can see the company is still doing fairly well, even though the share price has declined over 30%. We can see that in terms of its financial metrics, it has increased. So this is always a good indication that the company may be undervalued if the share price is dropping but its metrics are increasing. but that's not always the case. So we will go into the valuation to determine that. And then we can see in the chart year to date. So obviously there's not much here because we've just started the year. We're 5 days into January. So that's the year to date performance. And then over the past year, we can see it's gone down 15%. Before I get into the discounted cash flow model, please can I ask you to like the video if you are enjoying the content so far. Also subscribe, as this content is free and it motivates me to create more valuable videos for my subscribers. So now I will look at the discounted cash flow valuation in the second tab of this spreadsheet. And if you are using this spreadsheet for yourself, all you need to do is fill in the cells that are highlighted in yellow. So you can see I've already entered the free cash flow figure for the past few years, going back from 2016. So I've taken all this information from stockanalysis.com, and this information is freely available. So once I've filled in that, it's automatically calculated the growth year on year. And then at the bottom here, I've got the average growth rate over the past few years. And in the cell below, I'm putting my own projections. I feel like I'm being fairly conservative because the average growth rate is 17%, whereas I'm projecting a growth rate of 10%. You may decide to use a different projection figure. Maybe you are more bullish, or maybe you feel like you want to be more conservative. That's up to you. And in terms of the cash and cash equivalents, again, this information is all taken from stockanalysis.com. And then I've also got the total debt. So remember, you only need to fill in the cells that are highlighted in yellow. And if I scroll down, I've also entered in the shares outstanding. So I've done all of this already. And with all of these considerations, this comes to a discounted cash flow valuation of $193.25 US. So if I go back, I can see the current share price is below that. So that does indicate that maybe it is undervalued. But obviously I will also use the other valuation methods and give myself a margin of safety as well. So we will see what the total buy price comes to. I've chosen not to use the Benjamin Gray model because I don't believe that valuation will suit this type of company. So I'm going straight onto the multiples model. So in the multiples model, I've included other similar companies. Again, all you need to do is fill in the yellow cell. So I've got Mondelez, I've got PepsiCo, which also sells snacks, and General Mills, and Kellogg's, which I believe is now called Kellanova. So they're sort of in the same sort of industry, or at least in the snack industry. The one that's most closely related to Hersheys is obviously Mondelez, because that's directly in the chocolate industry. But all things considered, this comes to a stock price using this valuation method of $186, which I believe is more in line or slightly less than the current share price. So currently it's 189, and under this model it comes to 186. So according to this model, it is slightly overvalued. And in terms of the dividend discount model, this is usually one of the best metrics to use for dividend companies. For a company like Hersheys, this would be a very good valuation metric. So we can see the dividend payout over the past 4 years already populated in the yellow cells. It's very easy to do, and I've created a tutorial on how to do this, so do check that video out. And then that calculates the yearly dividends. And then we've got the growth rate per year. So the average growth rate is just under 12%. And again, I've been a bit conservative here by putting a growth rate of 6%. You may choose a more optimistic option, but this is entirely up to you. And then for me, the intrinsic value comes to $201 US, which I believe is higher than the current price at the moment. So if I go back onto my first tab and just scroll down at all my valuations, I'm just going to move this black box so we can see what I've entered. So as I mentioned, I've taken out Benjamin Gray model. So with these three valuations, it comes to an intrinsic value of $194, which I believe is more than the current price, which is $189.44 US. So that's the intrinsic value of the company. But I do want to give myself a margin of safety despite being fairly conservative in my valuations. So I've put a margin of safety of 10%. So again, you only need to fill in the cell that's highlighted in yellow. You may choose to use a different margin of safety, maybe 5%, maybe 15%, but it all depends on your valuations as well. So if you feel you're being conservative in your valuations, then you may feel like a bigger margin of safety is not necessary. So if I just move this black box further down, it will come to the buy price. So the buy price with a 10% margin of safety is $175 US dollars, which means at the moment it's currently a sell, and for me to buy it would need to drop a further 7%. That's with a 10% margin of safety. So if I wanted to increase this margin of safety, I could do so. So if I wanted it to be 15%, I'd have to wait for it to drop 12% for me to buy. And if I didn't want any margin of safety, because I feel like I'm being conservative in my valuation, I could literally just put a 0% margin of safety, which would indicate that it's currently a buy. So this is entirely up to you and your approach on how you feel like you would value the company. So you may choose to be more bullish on the company, you may choose to be more conservative, and you may want to increase your own margin of safety, but that's entirely up to you. I will now compare my valuation with other popular valuation sources online. So we came to a valuation without any margin of safety of $193.91 US dollars. Yahoo Finance valued the company at $210, and Simply Wall Street valued the company at $249. And remember to always do your own research. You should only be valuing a company if you have thoroughly looked into the company first. If you're still here, then I would really appreciate if you could like and subscribe to the channel for more content like this.